Hello and welcome to the third step in the FINA 5000 DCF tutorial. My name is Harrison, and in today's video, I'm going to be teaching you to project the items on the income statement by using historical averages to make your projections. So basically what you're going to be doing is you're going to be projecting out several of these income statement items and then calculating the rest to fill in the rest of this income statement right here so that you can eventually calculate the unlevered free cash flow for all of the future periods. So first, what we're going to calculate is the future revenues. But in order to make that calculation, we first need to come up with some sort of way to gauge how much these revenues are going to grow in the future. So what we'll use in this case is we're going to use the historical growth averages of revenues. So what we're going to do is we're going to go to the income statement, and then right here by sales, what we're going to do is we're going to calculate the compound annual growth rate in the sales, which equals parentheses the most recent sales divided by the 5 years ago sales raised to the 1 divided by 5 with that in parentheses. So then also you need to subtract 1 from it in order to get it as a percentage. And then now we are going to also format this in a similar way as before so that we know exactly what's going on when we come back and reference the sheet. So now that we have it all properly formatted, we're going to go back to the free cash flow sheet and we're going to reference this directly. We're going to go equals, then we're going to click it, and then we're going to hit F4 so that it's an absolute reference. That way when we copy it over, it won't shift around to different cells. And then we're going to copy this and we are going to paste formulas so that we don't end up messing up any of the formatting on this table. So what I just did there, the command key was Alt ESF and then enter. So I'm not a huge fan of all the weird shortcuts for Excel, and a lot of people in Terry will definitely disagree with me on that because it's a lot faster if you memorize all of them. But this is one that I found to be very useful. Again, it's Alt ESF and then enter, and that basically makes it so that you paste everything without messing up any of the formatting so that your table continues to look the way that it does despite the fact that you drag these formulas over. Now it's worth noting that if you don't want to actually memorize this key combination, another way to actually do this paste special and just paste over the formulas is you basically just copy it and then you select your area and you right click paste formulas and it does the exact same thing. So do whatever's easiest for you, but I found that using the actual key combination is a lot faster and it makes it so that you don't have to reach over and grab your mouse every single time. And it'll be especially important for this tutorial where it's very easy to mess up a lot of the formatting that happens within the DCF. Next, we are going to use this growth rate to actually project out our sales over the next 5 years. So basically, we calculate it as the previous year's sales times parentheses 1 plus the growth rate, and then we hit enter on that, and then we basically do the same thing we were doing before where we do the paste special and paste the formulas in, and now we have projected out our sales over the next 5 years. So next what we're going to do is we're going to project out the EBIT over the next 5 years. And the way that we're going to do it is we're going to calculate the EBIT margin in each of the last 5 years and then take the 5-year average of those EBIT margins so that we can assume that that's the EBIT margin going forward. And then we can simply calculate the EBIT as the assumed margin times whatever the revenues are in each of the future periods. So what we're going to do is we're going to go to the income statement. We're going to find where it says EBIT and we are going to insert a row underneath it. Then in this row, we're going to calculate the EBIT margin in each of the 5 years, which we basically calculate as the EBIT divided by the total revenues. And then we can copy and paste this over in these other cells. And we are again going to take the 5-year average of this and then this is also again a percentage, so we can format it in the same way that we have been with these other cells. Now that we have it properly formatted, we're going to go back to the free cash flow sheet and we're going to do an absolute reference to this number so that we can just copy the formulas and paste them for all of the future years. And then what we're going to do to actually project the EBIT is we're going to use this projected margin that's based off of the historical values. And we're going to multiply it by the future projected value of revenues. And then we're going to copy this and paste it out for the rest of the years. And then now we have projected EBIT for the next 5 years. Next, we're going to calculate the projected taxes based off of our effective tax rate that we calculated in our assumptions tab. So what we're going to do is we're going to go over here where the taxes line is. We're going to do equals the negative, and remember it's negative because we subtract taxes, of the EBIT times our effective tax rate. And you're going to want to make that an absolute reference so that it doesn't get dragged around when you paste your formulas. So then now we're going to basically just paste these formulas so that we have projected out our future taxes. Next, what we're going to do to calculate NOPAT is we are simply going to take our EBIT and we're going to subtract off the taxes, which since they're already a negative, we actually need to add that. So we simply add the two together, and now we have our projected net operating profit after taxes. Next, we are actually going to skip down and go straight to calculating the capital expenditures. And the way that we're going to do that is we're going to assume that CapEx is going to be a fixed proportion of sales going into the future. So in order to figure out what that fixed proportion is, we're going to have to go to the statement of cash flows, and we are going to actually calculate what it has been historically and then take the average of the last 5 years, similar to what we did with the EBIT margins. So this will be the CapEx over sales ratio. So then we take the CapEx and we divide it by, on the income statement, the sales. Now we can take this and paste it out, and then we'll take the average over these 5 years. And then again, we're going to have to format this. This is a percentage. So now that we have the proper formatting, so we know what this is in the future if we ever reference back to it, we can go back to the free cash flow sheet. And now we are assuming that CapEx is going to be a fixed proportion of sales of around 2%, which is what we just calculated. So we reference this, we make it an absolute reference, and then we are going to multiply that by the revenue in each year. And we can take that and we can again paste formulas so that it doesn't mess up any of the formatting that is already on the sheet. Next, we are going to project out the depreciation and amortization expenses. So in the terminal year, this one's actually really easy. We just set it equal to the capital expenditures. And the reason for doing this is if the CapEx and the depreciation and amortization weren't equal going on into perpetuity, then the company would grow its assets either infinitely or they would shrink down to zero. And that basically doesn't make any sense. You can't have an infinitely large company, and if it shrinks down to zero, then the company ceases to exist. So these have to be equal, otherwise the model would not make any sense logistically. So then next we need to calculate exactly what growth rate we need between these two numbers so that it grows by the same amount every single year. So this is just the compound annual growth rate as we've calculated before, which equals the most recent year divided by the 5 year ago year raised to the 1 divided by 5. And then we subtract 1 to get it into a percentage. So we get 8.24% as our compound annual growth rate. So what we're going to do is we're going to assume that depreciation and amortization is going to grow by this amount going forward. So you do the previous depreciation times parentheses 1 plus this compound annual growth rate. And then we're going to copy this formula and paste it over into the future years. So as you can see, the depreciation and amortization basically just grows until it hits the point where it equals the capital expenditures in the terminal year. The next step is we're going to fill in this plus depreciation line by taking the negative of the line that we just created, because we want to add depreciation here instead of subtracting it. Now our final step is to calculate the EBITDA, which uses the same formula we did before, where we basically just add back the depreciation. So we can actually copy this and just go straight over and paste in the formulas to calculate our EBITDA in the future. And we're going to do the same thing for calculating the EBITDA margin. So there you have it. In this video, we projected out the various items on the income statement in order to finish filling out our free cash flow table. In the next video, we will finish filling in this table by projecting out the change in net working capital in all of the future years. Thank you for watching this video, and I will see you in the next one.